Hey everyone, welcome back to Corporate Decoder, the place where we dissect the sometimes messy, often confusing, but always fascinating world of corporate filings. Today we're diving into Bloom Energy's latest quarterly report, and let's just say there are a few surprises. Is it growth? Is it debt? Well, that's what we're here to figure out, so stick around. Ready for the hook? Think of Bloom Energy as a high-tech company promising clean energy solutions. But are their financial statements as clean as their energy pitch? Let's find out if Bloom Energy is truly blooming or if there's a bit of wilting happening behind the scenes. This report covers Bloom Energy's performance up to March of this year. It gives investors a snapshot of how the company is doing financially and operationally. First, let's look at the balance sheet, which is a snapshot of what the company owns and owes. We will go straight to the numbers. Cash and cash equivalents, that's their short-term, readily available money, sits at $74, It's a good amount of cash to have, but actually it's a slight decrease from the end of the previous year. Accounts receivable net, which is money owed to Bloom, is at $333.9 million. This means people are buying their products, but it's crucial to collect that money. On the other side, their current liabilities, what they owe in the short term, stands at $584.4 million. It's important to have cash readily available in case they need it to pay for any liabilities. Now, long-term debt, that's where things get interesting. We are talking over $1 billion here, sitting at $1.01 billion is a hefty amount, so Bloom needs to make sure they have a plan to manage that. It could be the most important number in this report. Moving on to the income statement, which tells us how much money the company made and lost over the past 3 months. Total revenue was $326 million. It's an increase from last year, which is good, showing growth. However, the total cost of revenue, how much it costs to make the products and provide the services, is $233 a service, and $3 million. Zooming out now, the net loss, the overall loss after all expenses, is $23.4 million. This is not great for shareholders. Breaking that down, the loss per share available to common stockholders is 10 cents, showing that each owner of the company has lost 10 cents for each share they own. They had about 230 million shares outstanding when calculating that. That's still a lot of shares. The statement of cash flow tracks the movement of cash both in and out of the company. Net cash used in operating activities. This number tells you how much cash is generated from the company's day-to-day operations. In Bloom's case, they used $110 and $7 million in cash. Net cash used in investing activities was $14.2 million, and this represents money used in buying equipment, etc. Net cash provided by financing activities was $5.1 million. Alright, now we are into the footnotes. The nature of business section states that Bloom is in the business of providing clean energy solutions. Now the big question is, how are they going to keep the lights on themselves? The report mentions they have generally incurred operating losses and negative cash flows. This means they're spending more than they're bringing in, which is often the case for growth companies, but it needs to be monitored. Now, management says they believe they have enough cash to meet their needs for the next year, which is reassuring. Under revenue recognition, they describe where the revenue comes from, mostly money owed to them. They state that customer deposits decrease. That's not a good sign. It might indicate less future business. Let's check out the debt in the cash flow statements. It was a constant struggle between issuing and paying debt. Not great for the stability of a company. Level 3 assets requires more judgment, which makes it harder to verify objectively. The debt instruments paragraph shows that the fair value of all debts is over $1.5 billion, way higher than the stated debt of $1.1 billion. Under outstanding loans and security agreements, they say that they are in full compliance with debt covenants. I mean, they have to say that unless they are, in which case you know about it very, very fast from some other source. The weighted average remaining lease terms under leases section says the life of their leases is quite long, over 6 years. However, their lease liabilities keep on decreasing, so maybe there are not enough new customers to justify the same amount of leases. It should be analyzed on a deeper level. Under stock-based compensation expense, the total amount is over 32 million, which is also probably contributing to their net loss. Geographically, most of their revenue comes from the United States. That could be a risk if something big changes in the US market. The report discloses several risk factors that could affect their future results, including supply chain issues, competition, and government regulations, a government failing to give incentives. It could make it difficult for Bloom Energy to succeed. That's just speculation though. So what does this all mean? Bloom Energy is operating in a growing market, but they face a number of challenges, including heavy debt and continuing losses. The numbers reveal a few things. While revenue is up, profitability is still a problem. The long-term debt is the big elephant in the room, and the shrinking cash flow is a bit worrying. Looking at their strategic direction, Bloom seems to have a solid grasp of what's going on in the energy market and are trying to position themselves to take advantage of opportunities as they arise. However, government regulations are a serious threat for green businesses. Here's my take. I think Bloom Energy has a lot of potentials, but I wouldn't buy it right now. I think you need to see a few more quarters of solid numbers. Now it's your turn. Tell me what you think. Let me know your thoughts in the comments below. And while you're at it, subscribe, like, and share. I will see you in the next video.